We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me for this Wallet Watch Wednesday is Brian Williams at North Shore Consulting. Brian, how are you today?
I'm doing great, Eric. How are you?
Doing fantastic. So, what do people need to know about their money this week?
Well, there's really three big items for us, Eric. The first one is it's a new tax proposal from the Biden administration. So they're proposing a 20% minimum tax rate on households with more than 100 million in assets. I know you've got a great audience, but they're probably not all over that threshold, Eric. But over half of the revenue is going to come from folks with more than 100 billion. With 1 billion. What's interesting about these type of proposals, though, is, and we saw one last year, is it's a step into the world of taxing people on their net worth rather than their income. So you might make a case for that actually making more sense, but our system isn't set up that way. You know, this time of year, everybody's doing their taxes and they're reporting on the income that they made last year, not how much value is in their accounts or how much their house is worth or how many paintings they have. So it's interesting to watch these type of proposals, even though they might not affect you personally now. It does potentially open up a new revenue stream for the IRS to maybe make the tax system a balance sheet where, okay, write down all your assets and you're sending in, a certain percentage of your total net worth. So it's interesting to follow that, even though it might not affect you right now.
It is interesting. There's a couple of flaws in what they're proposing. I mean, first of all, who's to say how much value a painting goes up? How are they going to figure that out? And of course, if your stock portfolio goes down, are they going to give you a refund? There's a lot of problems with the proposal. But the one that I find most troubling is that this is not the first time that the government has tried to tax the highest earners. And most people, when they pay their taxes, are familiar with the term alternative minimum tax. And when this
Mhm.
was put in, it was meant to tax just the highest earners, and it ended up affecting somewhere along the lines of 70% of the population.
Right. And that's the whole basis of income tax in general, right? When it first came out, it was, well, it's not going to be for everybody. It's just going to be those super high. But we know these things sort of work their way down. That's why it's important to look at proposals like this, even though it doesn't fit your net worth right now.
Exactly. All right, so what else have we got?
Well, the other thing we're watching is the spread on government bonds. I know it's a little bit of a nerdy technical issue, but basically what it means is if you loan money to the federal government, what interest rate are they willing to pay you back? So in normal markets, the more years you loan money to the government, the higher interest rate they'll pay you. And when that gets a little bit out of whack, that can be a signal that a recession's coming. So right now, loaning money to the government for 5 years will give you a better interest rate than loaning it to them for 10, which is again that sort of wackiness. And the 2 year is actually approaching the 10-year rate too. So we're definitely keeping an eye on that because historically that's been a signal that a recession could potentially be coming.
Yeah, that's one of many that we've seen over the past several weeks. Pundits have now gone from, well, we might have a recession sometime this year, to now we're expecting one later in this year. Just to remind our listeners, a recession is defined as two down quarters. So you cannot predict a recession while it's going on. It's after it hits that everyone goes, oh, yes, that was a recession.
Right. Right. Yeah, it's gone from a matter of will we or won't we, but when is it going to happen, right? Later this year or next year. Yep. And the third thing we're watching is affecting business owners and employees, not just here in Connecticut, but across the country with these mandated state IRA programs. So California and Oregon have had one in place for a while. Connecticut, New Jersey, and Illinois are right on the doorstep. Every state's a little bit different, but the basic idea is any organization with a certain number of employees, usually 5 or more, is going to be forced to start an IRA program, 401k program, or be part of the state's IRA program. So employees can opt out of it if they'd like, but businesses are mandated to offer it. So I'm not going to beat up on the state plans. They're not terrible, but they're not great either. In most cases, employers or employees can find something different to invest in that's going to be a little bit more cost effective and a little bit more efficient with just a little bit amount of research.
So yeah, so businesses are being mandated to provide these, but how are these plans any different from the IRA plans that employees could have signed up for on their own previously to this?
Well, they're not, and that's what's important here is they're not building anything that's different. I mean, payroll deduction IRA programs, excuse me, you can get an IRA and get a routing number and an account number, just like you could your direct deposit and put a certain amount of money, dollars or percentages, as long as your company has a decent payroll system. I mean, you could have been doing that for the last 10 years or so. So the only thing that's really different here is they're putting it under the state umbrella, putting a logo and a website around it and saying, here's the shiny new object. You either have to do this or do something else. So again, not the greatest program, but you can do something a little bit better on your own.
Right. So there's no real, they're putting this mandate in place, but there's no real benefit to it. It's something that everybody could have already done, whether their employer was participating or not.
Correct. Yep. There's no better mousetrap here. That's for sure. There's a couple things they've done that supposedly streamline it for employers. And, the way they're pitching it is they say, no cost to employers, no cost to employers, which obviously we just know that means that the employees are paying the freight. So, it's easy for them to go out and talk to employers because that's who they're selling it to and saying no cost to them. But then it's the employees that are being burdened with the fees. So normally if a company is setting up their own retirement plan, they can decide to pay the fees for the employees. They can opt to kind of split it with the employees or let the employees pay it. But with the state plan, there's no choice. It's the employees are burdened with it.
All right. That's some great information. Thanks for being with us this week, Brian.
All right. Thanks, Eric.
That's the Raw Naked Truth. You can catch every episode of the Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Audible, Amazon Music, and wherever you find podcasts. We'll see you next time.